Welcome to the deep dive. We find fascinating sources, we dig in, and we try to pull out the most important insights for you. Basically, giving you a shortcut to being really well informed.
And today, we're doing something pretty cool, I think. We're stepping back in time.
Yeah, way back. Imagine 1987. It was a year with lots of economic shifts, some unexpected turns, and for certain companies, really incredible growth.
And we've got our hands on a bit of a historical treasure chest, the 1987 shareholder letter from Markel Group.
So our mission for this deep dive is to really unpack this document. What are the crucial lessons here?
Exactly. We'll look at Markel's financial wins, their pretty bold strategic moves, the acquisitions, and the core philosophy they laid out for shareholders. It's like getting a blueprint for their long-term thinking, right from an early pivotal year.
So what did Markel even look like back then? I mean, this is their first full year public. How were they setting themselves up for what came next and what was, a pretty dynamic environment?
Well, that's what's so interesting. This letter isn't just numbers. It's a story about growth, yes, but also about diversification and some really thoughtful risk management.
You can almost see the company's DNA forming, can't you? The principles that would guide them later on.
You really can. It's quite foundational.
Okay, so let's start with that snapshot of success. The letter kicks off sounding pretty confident, right? Declaring their first full year public had very successful results.
Yeah, almost celebratory. And what jumps out immediately is how they say their diversification strategy was already proving itself.
Right, they point out that claims, underwriting, and equity investments all beat their goals, and that this performance basically made up for the brokerage division, which was a bit weaker.
And the numbers behind that confidence are quite something. Net income for 87 hit $6.6 million. That's up 33% from 86.
Okay, solid increase.
And earnings per share, even with more shares out there after the IPO, still climbed 13% to $1.82. But the real eye-popper, I think, for anyone looking at financials.
Let me guess, return on equity.
You got it. Return on average shareholders' equity was a remarkable 35%.
35%, wow.
Yeah, and remember, their long-term goal, which was already ambitious, was 20%.
Yeah.
So 35% just blows that away. It immediately flags them as, incredibly disciplined with capital right from the start.
That is phenomenal for a newly public company. So was this just efficiency, or was the top line growing strongly too? How did revenue look?
Top-line operating revenues saw healthy growth, definitely, up 17.2% to $39 million for the year.
Okay.
But what's maybe more telling is how efficiently they managed it. Operating income jumped even more, 31.3% over 86, landing at $6.9 million.
So good leverage there.
Exactly. And that flowed down. Income after tax, before you even count realized investment gains, was $6 million, or 1.65 that year, a big leap from the year before. These numbers really do underline how well their early strategy was working.
It's interesting, though, that uneven performance. Brokerage falling short while the others did so well. Did they explain why brokerage struggled? What does that tell us about the risks, even with diversification?
Yeah, they did touch on it. The letter says the brokerage results were somewhat less than we had hoped. Basically, flat revenues and some products down because of increased rate competition.
Ah, the cycle turning already.
Seems like it. And it highlights something important. The unpredictable nature of certain income streams. They mentioned getting significant contingent commissions in 87 from good business placed at earlier years.
Right.
But they were careful to say those are difficult to predict. You can't really plan on them. It's a good reminder that even a solid diversification plan won't smooth everything out.
That kind of honesty is key, isn't it, for trust? But then you contrast that with claims operations and excellent year, as they put it.
A complete turnaround, really. Revenues up 13% to $11.3 million. And crucially, most of that increase went straight to the bottom line. They actually reversed a loss from 1986 in that division.
That's impressive. What drove that? Just better management?
Seems like effective management intervention, yeah. And at the same time, their insurance underwriting kept humming along. Earned premiums grew 41%.
41.
To $13.4 million. And the underwriting results themselves were quite good. And this wasn't just luck, it was planned expansion.
Okay, how so?
Well, Essex Insurance Company, one of their units, expanded its reach to 44 states, plus D.C. They built up a network of 70 producers. Plus, they got Markel American Insurance Company licensed in Virginia and started operations there. So it shows deliberate growth in their specialized niches.
Gotcha. And we know their equity investments also exceeded goals. How did those investments sort of pave the way for the big acquisitions that came later in 87, especially given the wider market context?
That's a great question because they absolutely did set the stage. It leads right into their big strategic plays. Markel took a 21.6% equity stake in Fairfax Financial Holdings Limited.
The Canadian holding company, right?
That's the one. And Fairfax itself held some interesting assets. Markel Insurance Company of Canada, big in Canadian trucking insurance. Sphere Reinsurance, doing Canadian property risks. And a majority stake, 53%, in Morden and Hellwig, which was Canada's largest independent claims administration firm.
Okay, so a lot of synergy potential there.
Huge potential. And Markel's share of Fairfax's earnings in '87 was $1.6 million, up from $1.2 million the year before. So this wasn't just a passive investment, it was building a strategic relationship.
And that relationship plays out almost immediately, doesn't it? December '87, Markel acquires Lindsay & Newsome Insurance Adjusters.
In a joint venture with Morden and Hellwig, Fairfax's company.
Right, so what was the big idea there? Just buying another claims firm?
No, it was much bigger than that. Lindsay & Newsome, based in Texas, was acquired with a very specific goal: build a full-service international claims adjusting and management operation.
Okay. Global ambitions.
Exactly. The letter even calls out Bob Irwin, Lindsay & Newsome's president, who'd built it into a leader in Texas, saying he'd be key in merging the claims operations. It was about building infrastructure, leveraging expertise.
And the accounting here is interesting for us trying to understand things. Because Markel owned or controlled over 50%, they consolidated Lindsay & Newsome's results, right? And that led to $5.9 million of goodwill showing up on the balance sheet for the first time. Can you unpack what that signifies?
Sure. Goodwill basically is the amount you pay over the fair value of the identifiable assets you acquire. It represents intangible stuff, brand name, customer lists, the strength of the management team.
Okay.
For a service business like claims adjusting, which doesn't need a ton of physical capital but can generate good cash flow, a lot of the value is in those intangibles. So paying that premium, creating that goodwill, signals Markel saw huge strategic value in Lindsay & Newsome's reputation and position.
That makes sense. Okay, so then, just 2 weeks later, the busy December, Markel and Fairfax each buy 35% of Shan Morahan and Evanston Services, the SE Group. What was their focus?
The SE Group was a major player in professional and product liability insurance. Think errors and omissions, that kind of thing.
A complex area.
Very. And SEA was big, $105 million in earned premiums, over $500 million in assets in '87. The letter highlights their exceptionally strong reputation and mentions being impressed by their chairman and CEO, Joe Prochaska. So again, it's about buying not just size, but expertise and reputation in a specialized field.
And the accounting differs again here, right?
Yeah.
Because they only bought 35%, not majority control.
Exactly. This $4.9 million investment showed up as investments in unconsolidated subsidiaries. They used the equity method, meaning they only reported their 35% share of SE Group's earnings on their income statement, rather than consolidating all of SE's assets and liabilities onto their balance sheet like they did with Lindsay & Newsome. It reflects that lower level of ownership and control.
Got it. These were clearly big, ambitious moves, but they must have cost a fair bit. The letter mentions taking on significant amount of debt. How do they frame that, given what we know about their usual financial style?
Yeah, this leads right into their financial discipline. They were very upfront about the debt, but also about their general dislike for carrying much debt. They stated their goal was to repay it as soon as possible.
So, willing to use leverage strategically, but not comfortable with it long term.
Precisely. It shows a management team focused on growth, but also deeply committed to financial prudence. Take the debt for the opportunity, but have a clear plan to get rid of it quickly.
That kind of transparency really brings us to another fascinating part of this letter, how they talked about uncertainty and risk. They even introduced something called the Markel style.
Yes. They actually restated their corporate values around marketing, human resources, and financial goals. The emphasis was on shared goals, commitment, bringing together diverse people for success.
And what I found remarkable was how direct they were about risk. They literally addressed the question investors were apparently asking, what can go wrong?
It's incredibly direct, isn't it? They acknowledge you can't eliminate all risk. That alone builds trust. They weren't trying to sugarcoat things. They were facing potential problems head-on, preparing shareholders. Very rare, especially back then.
So what were the big risks they specifically called out?
They highlighted three. First, the classic insurance cycle.
Always a factor in this industry.
Always. Rates go up, rates go down, often disconnected from actual costs. They noted that after big rate hikes in '85 and '86, things were already softening in '87, competition was increasing.
So how did they plan to manage that cycle?
Their core strategy was specialization and diversification within insurance. Be leaders in different unique niches, claims, brokerage, underwriting. The idea was that a downturn in one niche wouldn't necessarily hit all their businesses at the same time. It's a built-in buffer, really.
Makes sense. A defensive moat through diversification. What was the second risk?
Estimating loss reserves. This is absolutely critical in insurance.
Right. Getting that wrong can sink you.
Exactly. They pointed back to the early 80s when many companies underestimated claims costs due to inflation and social factors. Those companies ended up bankrupt or taking huge hits to earnings years later when reality caught up.
So Markel's approach.
Be conservative. Use both internal and external actuaries. They felt their track record was good and their reserves were more than adequate. It shows a real focus on prudence, learning from the industry's past mistakes, strong financial management.
Okay, and the third risk they mentioned was expansion risk. Comes with the territory when you're growing fast like they were.
It does, but I loved how they framed it. They acknowledged the risk, but said they believed the greater risk is to stand still.
That's a powerful statement. Proactive.
Very. They weren't saying no risk, they were saying we manage risk. Their commitment was to minimize growth risk, and they explicitly stated they plan to absorb the recent deals before doing more expansion.
So ambitious, yes, but disciplined about the pace. Eyes wide open.
A really intelligent balance, I think.
And speaking of management, they also beefed up their board in '87, didn't they? Two key additions.
They did, and they were very strategic picks. First, Edmund G. Langhorne, or Ned, president of National Claims Service. He'd actually joined in late '86, and the letter credits him with turning around the claims operations, which we saw had that excellent year.
Okay, vital operational expertise.
Definitely.
No.
And second, Leslie A. Grandis, Les, a partner at their law firm, McGuire Woods Battle and Booth. He was their corporate counsel, advised on the IPO in '86, and guided them through the legal complexities of those big '87 acquisitions.
So bringing in crucial operational and legal firepower during a period of intense activity makes sense.
Absolutely. And they didn't just add people. They reiterated their long-term financial goals, too. Still aiming for 20% revenue growth and that 20% return on equity over the long haul.
That consistency is striking, isn't it, for a company just starting its public life?
It really underscores that focus on disciplined, profitable growth. And something else that resonates is how they talked about shareholder alignment.
How?
They plainly stated their belief that shareholder return comes from increasing the company's value, adding, because we, like you, are shareholders.
Simple but powerful, creates that sense of partnership.
It really does. Management's interests are aligned with the owners, and then they wrap up that section by giving credit where it's due, recognizing the nearly 700 men and women of Markel, whose efforts made it all possible, acknowledging the people behind the performance.
What a fascinating trip through 1987 with Markel. We've seen stellar financials, really bold strategic acquisitions expanding their reach, that clear-eyed, honest discussion of risk, and the embedding of the Markel style. It truly feels like a glimpse into a company consciously building its foundation for the very long term.
Yeah, the key takeaway for me is how that combination, diversification, disciplined growth, and just remarkably frank communication really shaped their path in a pivotal year. They weren't just reporting, they were articulating a clear vision and strategy.
Absolutely.
Yeah.
Which leads to maybe a final thought for you to consider. Given how openly Markel discussed risks like the insurance cycle and expansion back then, what's the lasting impact of that kind of transparency? Does it build more resilient investor confidence? Does it make a company maybe better equipped to handle future uncertainties and seize new opportunities? Something to think about when you look at company communications today.